Common measures of return introduces several important methods used to measure and interpret investment performance in financial analysis. The topic explains that returns are often expressed on an annualized basis to allow meaningful comparisons across investments with different holding periods. Annualized returns convert holding period returns into equivalent yearly rates, helping investors evaluate performance consistently. This standardization is especially useful when comparing short-term and long-term investments. The topic emphasizes that return measurement is a foundational concept in finance because investment decisions, valuation models, and portfolio management all rely heavily on accurately understanding and comparing rates of return across different financial instruments and time horizons. The topic explains how annualized returns are calculated for investments held over periods shorter or longer than 1 year. For shorter holding periods, the return is compounded to estimate the equivalent annual growth rate. Similarly, returns earned over multi-year periods can be converted into annual terms to simplify analysis and comparison. The topic also discusses how compounding frequency affects future value and present value calculations. More frequent compounding increases the effective interest rate, leading to higher future values and lower present values. Examples using annual, semi-annual, quarterly, monthly, and daily compounding illustrate how even small increases in compounding frequency can slightly alter investment outcomes and valuation estimates. A key concept introduced in this topic is continuous compounding, which represents the mathematical limit of increasingly frequent compounding periods. Continuously compounded returns are calculated using the natural logarithm of 1 plus the holding period return. The topic demonstrates how these returns can be derived directly from price relatives, which compare ending investment value to beginning value. Continuous compounding is widely used in finance because it simplifies many analytical models and possesses desirable mathematical properties. One particularly important property is additivity. Continuously compounded returns over multiple periods can be summed directly, making them especially useful in portfolio analysis, derivative pricing, and advanced financial modeling applications. The topic then distinguishes between gross return and net return. Gross return refers to the total portfolio return before deducting management and administrative fees, although transaction-related costs such as commissions are already included. Net return, by contrast, represents the investor's actual return after all fees have been deducted. This distinction is important because management fees can materially reduce long-term investment performance, particularly in actively managed portfolios. Analysts and investors must therefore clearly understand whether reported returns are gross or net when evaluating investment managers or comparing portfolio performance across different funds and investment strategies in the financial marketplace. The topic also explains nominal returns, after-tax returns, and real returns. Pre-tax nominal return measures investment growth without considering taxes or inflation, while after-tax nominal return accounts for tax liabilities arising from dividends, interest, and capital gains. Real return adjusts nominal return for inflation and therefore measures the increase in purchasing power achieved by the investor. The topic highlights that inflation reduces the true economic value of investment gains. For example, if an investment earns 7% while inflation is 2%, the investor's real return is approximately 5%. Real return is particularly important because it reflects the investor's actual improvement in economic well-being and consumption capacity. Finally, topic introduces leveraged returns, which arise when investors use borrowed funds to increase investment exposure. Leverage magnifies both gains and losses because returns are calculated relative to the investor's original equity investment rather than the total value of the underlying assets. The topic provides examples involving futures contracts and leveraged real estate investments, where only a portion of the investment is financed with personal capital. Leveraged returns are highly sensitive to borrowing costs and asset performance, making them riskier than unleveraged investments. The topic concludes by emphasizing that understanding these different measures of return is essential for evaluating investment opportunities, managing risk, and making informed financial decisions.